This is part of the big shift we've seen over the last 12 months. 12 months ago, we were in bubble-type conditions. You had cryptocurrencies shooting through the roof. You had everyone focusing on FAANG stocks, and the sort of expectations were just getting exponentially higher. That's now changed. You've now got a position where people are looking at FAANGs. They're still producing fantastic growth, but they're slightly disappointing. You talk about Apple, but you've got Tesla people looking at, Netflix not generating the demand growth perhaps people were expecting. And as a result, if you've got lower earnings growth, and also it's a little less certain, the multiples have got to come down significantly in terms of what you're prepared to pay for that. So FAANGs, they're off 35% or so since the summer. That bubble has burst. How far they go from here, I don't know, but they're no longer leading the market, and that's the key thing. But the market in general, compared today with a year ago, the US was on a forward PE of 20 times, it's now on a forward PE of 15 times. There's a big difference in terms of overall valuations.
But does that make you more excited to want to own it, or are you less interested because the multiple's fallen for reasons?
So I'm much more interested in the market as a whole than I was this time last year. This time last year there was a real concern that, hold on, things are just, this is bubbles, and once you're into bubble type territory, what do you do in that? Once you've got out of that, you can now start saying, well, let's look at the individual stocks and look for ones that are attractive. And it's not just the US that's cheaper. I talk about that PE falling. The PE for Europe last year was 15 times, and you sort of thought, well, does it really justify it given the growth? Well, now it's around 11.5, 12 times. So things are a lot more attractive. The difficult decision is to say, well, what's happening to earnings growth, and are we going into an economic slowdown that causes a crisis?
Yeah, so on that point, Jonathan, it's sort of interesting. You've had the first sort of forms of derating, but is it that we now start to see, with the sort of revision to ratios starting to come through much more aggressively, that actually it's the real earnings numbers that will change, and therefore that derating as it comes through actually is not as meaningful as one first thinks, because there is actually underlying income revenue destruction starting to take place for some of these companies as well.
So yeah, so we've had, last year was a fantastic year for earnings growth, US in particular, but elsewhere we had good earnings growth. This year we're still looking at a little bit of earnings growth, in the US falling from 20% growth to perhaps 8% growth. I think we've still got earnings growth. The problems you've got to look at is twofold. One, are we going to have a recession? I don't think we're going to have a recession. What we're having is an economic slowdown. And two, a profit margin is going to come under threat. And profit margins, the main area I would look at is what's happening to the cost of labour. And the cost of labour we can see is incrementally going up in the US. It's average earnings rising by about just over 3% at the moment. Those two, a slowdown in demand growth and a push in terms of an increase in labour costs, could squeeze margins, and that's the big threat. At the moment, I think you can still get earnings growth, which is why I'm still interested.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.